Something unprecedented just happened in global capital markets, and if you blinked, you missed it. BlackRock, the largest asset manager on the planet with $14 trillion under management, quietly repositioned to $1 trillion in capital exposure trillion with no press releases. Number news coverage, no headlines, no fanfare. This wasn't speculation on social media. This wasn't some newsletter trying to scare you into clicking. This was real money, real positions, systematically relocated across global markets. And the direction of this move reveals exactly where the next wave of wealth creation is heading. In the next 12 minutes, I'm going to show you exactly what BlackRock is doing, why this shift is accelerating in early 2026, where that $2 trillion is flowing, and most importantly, how you can position yourself to profit before the general public even realizes what's happening. Once this appears on CNBC or Bloomberg as breaking news, the easy money will already be gone, and the institutions will have already positioned themselves. To understand the scale, most people don't fully grasp what BlackRock is. This isn't a hedge fund taking risky bets. This isn't some individual making intuitive predictions. BlackRock manages $14 trillion in assets, which is larger than the GDP of almost every country on Earth except the United States and China. To put it simply, if the global stock market were a chessboard, BlackRock doesn't just have pieces on the board, they own the board. They are in your 401k, your pension fund, your university endowment, sovereign wealth funds. They are the top 10 shareholders of virtually every S&P 500 company. Apple, Microsoft, Amazon, Exxon, JP Morgan, they own significant stakes in all of them. When BlackRock decides to move capital on this scale, it's not speculation. It's calculated repositioning based on intelligence, demographics, policy trends, and proprietary data that retail investors will never see. Larry Fink, the CEO, has access to economic intelligence that costs millions of dollars to compile. His team study currency flows, global policy, demographics, and probabilistic models. But here's the most important part. You don't need their data, you just need to watch their hands. And their hands recently moved $1 trillion out of U.S. market exposure and into emerging and international markets. Let me be very clear about what this means. It does not mean the U.S. is collapsing tomorrow. It does not mean you should panic sell everything and move your life savings abroad. What it does mean is that the center of gravity for global growth is shifting. Capital flows like water, it seeks the path of least resistance and the highest return. For the first time in over a decade, that path is leading away from U.S. equities and toward international markets. Timing is everything. Retail investors react to headlines and emotions. We buy when we're greedy and sell when we're scared. Institutions like BlackRock move before the news even exists. By the time CNBC or Bloomberg explains a trend to the public, the trend is already crowded, and the alpha, the excess return, is gone. Let's look at the numbers driving this global rotation. In 2025, the US dollar declined significantly against a basket of global currencies. When the dollar weakens, your purchasing power drops. Even if your stock portfolio stays flat in nominal terms, you lose real wealth because your dollars buy less. Meanwhile, global equity markets outside the US surged. Germany's DAX returned approximately 22%, Japan's Nikkei about 26%, and the MSCI Emerging Markets Index nearly 30%, compared to the S&P 500's 16%. 16% is good, but compare it to 30% in emerging markets, and you see the opportunity cost of home country bias. A weak dollar combined with rising international equities creates a double tailwind. Your assets appreciate, and foreign currencies strengthen against the dollar, increasing your returns further. Now let's address the elephant in the room. Aren't emerging markets risky? Don't they experience volatility? Absolutely, over short periods. But over long horizons, 10, 20, 30 years, emerging markets have consistently outperformed developed markets. Why? They have young, expanding populations driving growth. The US, Europe, and Japan have aging populations and shrinking workforces. Emerging economies like India, Brazil, Indonesia, and Vietnam have millions of young people entering the workforce every year. These populations consume, invest, innovate, and drive growth. Capital follows growth, and right now, emerging markets represent the next major opportunity for wealth creation. Instead of trying to pick the single winning country, a diversified approach is safer. ETFs like VWO, EWJ, and M are capturing this capital rotation. VWO, the Vanguard Emerging Markets ETF, gives exposure to fast-growing economies like China, India, Taiwan, Brazil, and South Korea. These countries have young populations, strong growth potential, and opportunities for massive capital appreciation. EWJ, the iShares MSCI Japan ETF, surprises many. Japan has undergone corporate reforms, improving shareholder returns, buybacks, dividends, and operational efficiency. The weak yen boosts exports, making companies like Toyota, Sony, and Mitsubishi globally competitive again. M, the iShares MSCI Emerging Markets ETF, is the broadest fund capturing macro-level global growth. Institutions use it to bet on the entire developing world outpacing the US. Rather than gambling on a single country, psychology is as important as fundamentals. Every major capital rotation feels uncomfortable before it becomes obvious. Fear precedes opportunity. In 2009, buying US stocks after the financial crisis felt terrifying. Yet those who did saw off 100% plus returns over the next decade. In 2020, buying during the COVID crash felt insane, yet the market doubled in 18 months. Patterns repeat. Fear signals opportunity if you are positioned early. Waiting for certainty is the most expensive mistake. Institutions act on probabilities and forward-looking data, not past headlines. This doesn't mean abandoning the US entirely. Certain sectors, defense, industrials, rare earth minerals remain strong and stable. Ignoring the $2 trillion shift, however, is the real risk. Position early, stay patient, and let compounding do the work. Gold and silver add another layer. Basel III now treats gold as a Tier 1 liquid asset, enabling banks to leverage it as cash. Price movement isn't just fear-driven, it's utility-driven. Institutions positioning for these changes impact your 401k and retirement accounts. Whether you own gold directly or not, the game also plays heavily on emotions. Bad news drops when markets are closed, creating fear over weekends. Retail investors panic, sell, and the market dips. Institutions quietly buy at a discount. By midweek, rumors surface, and the market rallies. Pullbacks are just institutions moving chips from one table to another. Every major rotation feels scary before it becomes obvious. Follow the footprints, not the panic. For action, diversify into ETFs capturing emerging and international markets. Monitor sectors that thrive during geopolitical or economic turbulence. Stay disciplined, patient, and avoid emotional trading. By positioning yourself now, you align with smart money before trends are widely recognized. Once the rotation is obvious to retail investors, the returns are already claimed by institutions. Timing, patience, and data-driven decisions are your edge. And if you want to stay ahead of this global capital rotation, make sure to subscribe to Economy Unfolded and turn on notifications. BlackRock just moved $1 trillion. The choice is yours. Follow the smart money or miss the opportunity.